The 2008 financial crisis was one of the worst economic disasters in history. It wiped out trillions of dollars, caused millions of job losses, and nearly collapsed the global banking system. One of the biggest culprits, synthetic CDOs. These financial products were so complex that even many bankers didn't fully understand them, but they played a huge role in turning bad mortgage debt into a global catastrophe. So, what are synthetic CDOs, and how did they help crash the economy? Let's break it down. What is a synthetic CDO? First, let's talk about CDOs, Collateralized Debt Obligations. A regular CDO is a bundle of loans, like mortgages, car loans, or credit card debt, that banks package together and sell to investors. But a synthetic CDO is different because it doesn't contain real loans. Instead, synthetic CDOs are made up of credit default swaps, CDS, a type of financial insurance that allows investors to bet on whether other investments will succeed or fail. Think of it as a casino. Instead of buying real assets, investors were placing bets on whether mortgage-backed securities would default. How did synthetic CDOs make the 2008 crisis worse? Synthetic CDOs made the crisis much worse because they allowed banks and investors to create more risk out of thin air. Instead of just losing money on bad mortgages, banks multiplied the impact by creating bets on those bad mortgages. Investors were making huge profits as long as the housing market kept rising. But when people started defaulting on mortgages, synthetic CDOs amplified the losses across the entire financial system. A single bad mortgage was no longer just one bad loan. It was linked to thousands of synthetic bets. Who made money and who lost everything? A few smart investors saw the danger and bet against synthetic CDOs, like Michael Burry, featured in The Big Short. Winners, hedge funds and traders who shorted the market made billions. Losers, banks, pension funds, and regular people who invested in what they thought were safe assets got wiped out. Everyday homeowners, who were given bad mortgages, suffered the most, leading to mass foreclosures and job losses. The fallout and lessons learned. When the housing market collapsed, the losses from synthetic CDOs were so huge that major banks failed overnight. Lehman Brothers went bankrupt. AIG had to be bailed out with $85 billion. The US government had to step in with a $700 billion rescue plan. After the crisis, new laws were introduced to limit synthetic CDOs and risky bets. But some experts believe history could repeat itself with new financial products. Synthetic CDOs were one of the most dangerous financial weapons of the 2008 crisis. They magnified losses, fueled risky speculation, and nearly brought down the global economy. What do you think? Could another financial crisis happen because of new risky investments? Let's discuss in the comments. Like and subscribe for more financial breakdowns, economic insights, and deep dives into Wall Street secrets.